Hello, everyone, and welcome to LPL Market Signals. Jeff Bookbinder here with my friend and colleague, Kristian Kerr. Kristian, I started the week recovering from taking my teenage daughter to the Sabrina Carpenter concert
Okay.
in New York City. I recovered from that, then I got sick, and then the market started selling off. So now I am continuing my recovery. It's been a very long week. How are you?
Better than you, it sounds. I have not, I did not go to Sabrina Carpenter concert, so I'm in better health than you are right now.
You started the week strong and you had enough in the tank to get through this market volatility this week. I was not so fortunate. Yeah, so I got a little bit of a cold, but I'll fight through it. The certainly main topic, I think, really for the whole week, but definitely here over the last couple of days is the sell-off in tech. So we'll get Christian's thoughts on that. Um, it's not just tech though, because you had some layoff announcements that I think caused the market to question whether the job market's going to hold up or not. So you layer that on top of the government shutdown, on top of the credit fears that we've talked about over the past several weeks, and it looks like it was just a little too much for the market to handle. So getting a little bit of a sell-off here that we will dissect, and then also preview the weekly market commentary done by our chief economist, Jeffrey Roach, and he attempts to put the AI investment in context, in the context of the overall economy. We'll just show you one chart from that commentary. It isn't out yet as we're recording this anyway. It's Friday, November 7th, 2025. We are recording early because I will be out on vacation early next week, continuing my recovery from this past week. So anyway, we'll give you some quick highlights on the WMC, which you can find on the LPL.com website under research. And then we'll close like we have the last few times with a week ahead that has uncertainty in the calendar, right? We don't know if we're going to get government data or not next week. Probably not. All right. So market recap. I mean, you could argue that I didn't put enough on here, but AI valuation reset and layoffs, I think, is probably enough to describe most of the decline. This is a 5-day look that includes the previous Friday and does not include this past Friday. So as we're recording this, we're down about 2.5 on the S&P. The overall pullback is not even 3.5% right now. So pretty mild, although it's still the biggest pullback we've had in 5 months. I believe it was June when we last saw a pullback of even three. And you've got to go back farther, Christian, to get a pullback of more than five. So just put the
Yeah.
week in perspective here. What do you think of the main drivers, and what do you look at that might give you some confidence that we'll be able to get our footing here soon?
Yeah, I mean, I think the clear thing is there hasn't been necessarily one thing you can point at to say that's what's driving this correction. So I think it's a mix of different factors. Some of the things you highlighted. I mean, honestly, I think the Fed last week, the market started to get a little bit more defensive post the Fed, right? Where they kind of threw a little bit of cold water on there being a cut next month. Still probably think there will be one, but just the chances of that. But I think since then we've kind of seen this kind of more negative price action in the markets. I think that's definitely part of the story. But then to your point, we got those challenger layoff numbers yesterday. It clearly had a little bit of an impact on the market as well. So I think we're kind of, we've got a lot of this minor macro headwind, I think is really what's driving things here. And the fact that, we were just, quite frankly, very overbought. And I think that was a fairly decent recipe to kind of get the pullback that we've seen. I think we're at a pretty, in the broad index, at certain levels, I guess, in the broad index that where you would expect the market to try to turn back up. Starting to see it maybe happen here this afternoon, but that's kind of the way I'm seeing it. Just not really any one thing I can put the blame on for this other than just over a little bit of an overbought market with, a few negative headlines between the Fed and some other things that have put a little pressure on the indexes.
Yeah, I mean, we've expected a pullback as many have for a couple of months now. It just didn't come when we would have expected it to. The seasonally weak period of September and October was a logical time for it to come, and it did not. So I guess it's coming now. It's coming in November, but it's a little bit later, I think, than we thought. So the other thing to keep in mind is if you're trying to sidestep a pullback, in most cases, you'll probably end up buying higher than you sold because you might predict a 5%er and get it, but by the time you get it, you might go up five, down five, and you end up no better than if you just held. So it's really tricky, really difficult to sidestep these minor pullbacks. What we try to spend our time doing is figuring out if we're going to get down 10 or 20. And right now we don't see that. So turning to the bond market, I mean, I guess you could say it's a silver lining that the bond market has behaved actually better than behaved. It's been strong, certainly for the past few months. And the slowdown in the job market, Kristian, actually helps the bond market, right? And it helps inflation. Even though we're not getting inflation data, I don't think people are worried about inflation anymore. I think people are just worried about the growth picture. That's good
Yeah,
for bonds.
yeah. I mean, I look at the bond market right now, and it just, you have to squint to see anything really going on, right? I mean, it's been in this protracted range for a long time. So if you look at it from a technical lens, yes, we did kind of challenge the 50-day moving average to the upside this week. That kind of failed, but we're really not going anywhere. We've been kind of in the lower end of a range for the last few months. So it's tough to really kind of say anything significant's happening in there. I mean, I think the bond market probably took what happened with the Fed last week and is saying, okay, we'll price that out a little bit, but we're still baking in a cut, right? So we're not really seeing any real material price action in bonds, which I think ultimately is helping kind of stocks not really sell off too aggressively. If you were to see kind of a bigger move higher in rates, that might have been kind of putting a little bit more cold water on kind of this equity narrative. I think also too, the government shutdown's probably playing another role in kind of what's going on, at least in kind of in the funding markets, and we've talked a little bit about that. But just this idea that you've got kind of liquidity diminishing system wide. We've kind of seen some odd things going on in kind of the repo markets. And I think if we were to get kind of a headline saying, the shutdown's over, that's gonna reintroduce liquidity. Might even be a catalyst for pro risk. Obviously, like the shutdown hasn't been a big market driver. It's been kind of happening in the margins, kind of in these funding markets where you could say there's been an impact. But generally speaking, when you get kind of liquidity diminishing, it's rising tide lifts all ships. It kind of it doesn't help the equity story when you have that happening. So I think that's kind of the big takeaway for me is if we do kind of see any headlines, which I think we probably will, because I don't think either side wants to be going into Thanksgiving with the government still shut down, just given the travel issues that could cause. You got to assume they're going to come to the table at some point. So that's a potential positive catalyst, quite frankly. But that's kind of the way I'm thinking about it right now. Just not a whole lot going on from a technical perspective where I start first when looking at these things. And it's going to take something from a headline perspective to really, I think, move things one way or another.
Yeah, and for those thinking that the refunds of illegal tariffs might cause the bond market to sell off, you're going to have to wait a while.
Yeah.
Because even though the hearing just happened, they're going to have deliberations for a while. We might not get a decision until next year. So at that time, could the bond market sell off a little bit on less tariff revenue to the Treasury? Maybe, but that will be temporary because the Trump administration is going to shift. They're going to add new legal basis for tariffs. They're going to slap them right back on. There'll be a delay, but they'll get them back on. That the market should price in that revenue to the Treasury continuing. Maybe not all of it, but most of it. And then that leads you to the conclusion that it shouldn't really influence the bond market. So I'll add that to the mix. How about commodities, currencies, Christian? I mean, gold's gotten its footing a little bit after the sell-off. Certainly that was overbought, just like tech.
Yeah, it's one of these things, I guess another big narrative that we've seen, really the past year has been momentum, and gold has been riding that momentum wave as well. So I think, the sell-off we saw really, I mean, it really kind of kicked off when, you started to get margin requirements increase in the gold market. So, more expensive to hold gold with leverage. That kind of kicked things off, and then um, kind of got a pretty decent sell, but we're just hanging around that $4,000 an ounce mark. Just given kind of how euphoric or some of the excess speculation we were seeing in gold, doesn't really surprise me that we got, a fairly material sell-off. Honestly, I probably had to see us get under 3,600 ish to really kind of start thinking that maybe there's a bigger dynamic going on here in the gold market, just because we had such a big run up. I think what's interesting in commodities, honestly, is the fact that, if you look at the Bloomberg Commodities Index, you and I had a call yesterday, the morning call, where we talked about the Bloomberg Commodities Equal Weight Index, which is breaking out the new highs. So what's interesting to me is that you're starting to see uh, some some very positive price action in commodities outside of the usual suspects that drive indexes, which is oil and gold, which are both kind of in a weakening phase right now. So I think there are some interesting stories going on in commodities outside of the main ones, which I think has maybe some implications here. Need to see kind of how things play out. But the fact that you do have the equal weight commodity index breaking out is something I think worth watching here.
Yeah, so maybe watching oil is kind of like the bond market, nothing going on, paint dry, grass grow. But yeah, beyond that, I agree it's getting interesting. And then copper's been certainly doing well and has some structural supports. So we'll continue to watch that, and obviously we'll keep watching the dollar as you always do, Christian. All right, let's get deeper into the sell-off. So I guess we're gonna look at the sell-off here. It's small, but for now, through these various lenses of seasonality, sentiment, and breadth. And then, of course, everybody's watching the Mag 7, which is sold off more than the broad market and really leading, I would say, probably the way down. So we'll certainly talk about that. And I guess you've got four charts here, Christian. So we'll start with seasonality. This is something we showed you a couple of weeks back. The best 6 week window starts now, huh? Doesn't
Yeah,
feel like it.
yeah. I kind of want to put together kind of a little bit of a narrative through all these charts, but basically, kind of my bigger level thinking here really is that, there is a big behavioral aspect to the stock market, particularly around this time of year, where it becomes a lot about, is the stuff that worked throughout the course of the year going to continue to perform into the end of the year, right? And you've got kind of this dynamic, especially in the institutional world, where you have managers saying, well, I'm lacking performance, so I need to buy what's been working to catch up in the end of the year. Likewise, you can get the same questioning saying, well, I've had a good run in these things. Do I take some chips off the table ahead of end of the year and lock in a good year, right? So I think that is a really big dynamic that drives markets starting in November. And the reason I wanted to kind of show this seasonality chart is that coming into November, my inbox was full with different, sell side kind of emails talking about, well, November is the strongest month, and we're about to get this kind of performance chase starting early, and it was almost palpable, the degree of excitement we were getting. And a lot of it was because of this whole sentiment idea. Now, what's a bit odd about sorry, about seasonality, what's been a bit odd about seasonality is the fact that it didn't really work, as you mentioned earlier, Bookie, during the weaker period. But then there was almost this belief that, well, it's going to have to work now all of a sudden, right? So I think the fact that seasonality hasn't been working that great all year makes it a little less of a clear signal coming into November. So we've kind of seen that dynamic play out a little bit here. But that doesn't mean to say we can't get it, right? A lot of the times we'll look at these seasonality signals and say, well, you're going to have a strong month that's going to start from the first day of the month and continue on to the end. And a lot of times it's the path to get there that really matters. So maybe this is just it's still going to play out, but you have to kind of go through a little bit of a shaking of the tree first, which maybe is what we're going through right now. But I thought that was just interesting how much people were talking about seasonality coming in November, and almost too much so to where we've gotten this negative price action, almost right out of the gate, start from the start of the month when everyone's looking for a strong month.
Yeah, so a market that priced in a little too much enthusiasm, and as you have in a later slide here, maybe was getting a bit complacent. Uh, I think it's also reasonable to say that we pulled forward some of these gains, right? Like you said, the last 6 months have been very, very strong. I think it was one of the best 6 month periods ever during the sell in May period. So coming off of that, a little bit of a pullback makes some sense. So here's complacency, right? Just alluded to it. This is probably a reason why we're getting some jitters now.
No, it's going to show, how much excitement there really was coming into the month on this, idea of a performance chase starting now. The seasonality aspect, and this is the CBOE put call ratio, and you can see I put that green line is a 2 week moving average, and really what I was saying, there might be an air of complacency is that we just kind of got to pretty low levels, so people buying calls, not buying puts. And just we're very steady through, the fall, through much of October, started to pick up a little bit towards the end of the month, last month, but really haven't, there's still kind of this excitement in the market. I would even say a little bit of uber speculation we were seeing really in some of the kind of, for lack of a better word, the junkier names in the market. Right, we're having some big runs. It's really started to kind of peak out in October, but really, I was just trying to highlight that there was, a lot of excitement coming into the month, based on this notion that we have to get a performance chase starting right here and now, and the markets was skewed that way. I look at another sentiment index called the daily sentiment index, which looks at tracks, um, basically retail futures traders, right? They tend to be trend following in nature, that cohort. And that got up to the mid high 80s of sentiment, which is pretty extreme. So 80-85% call it, were bullish on the S&P continuing higher. There was another sentiment survey conducted by ISI, right? So mostly institutional accounts, and they were asking them where the next 10% was going to be in the market, and that was at all-time highs, in terms of coming up, kind of looking forward to the next few months as well. So a lot of sentiment was skewed to the market going higher. So a lot of times, when you look at this from a contrarian lens or perspective, that means you might need to see a little bit of a pullback just to kind of temper those expectations a little bit, which I think is kind of what we've seen here the last week or so.
Yeah, so for those who aren't familiar with the options terminology, the put call ratio, when you have more puts, that's more fear. So naturally, this ratio spiked in April of this year around the Liberation Day tariff scare. You have these other little sell-offs that have caused more fear, but when this reading is low, that's kind of complacency, right? So late October, mid-October, actually mid-October was about as low of a reading of this as we've gotten this year. So that is a very complacent reading, which set the tables for the volatility that we've seen this week. So this is a really interesting chart here because people look at the S&P 500 and they say, oh, it's down 3.5%. That's not much, no big deal. But if you look underneath the surface, you actually have a lot of names that are, I mean, not only in correction territory, but in bear market territory.
Yeah. Yeah, I want to highlight this just from going back to that lens that you had this kind of excitement about a performance chase going into the year, what's been working, and I think you can really see it in this chart, just giving like how narrow the breadth has been. It's basically been, like I was saying, Mag 7 and some of these kind of, you know, junkier parts of the market where there was a lot of kind of self-directed retail euphoria in it, and everything else has been struggling, right? Whereas Adam pointed out in this chart, your median stock is you know down around 15%, pretty close to, closer to bear market territory than bull market territory. So it's been a very, very narrow market. The traditional way to look at breadth was always, well, if you've got a market rising, but it's only being led by a few, that's a potential negative. I would argue that's changed a lot in the era of passive investing, of factor analysis, all these types of things. We've had generally not great breadth for a lot of this bull market. So I'm not sure how significant it is, but the fact that we are kind of got to pretty extreme levels here, I think it was too much for the market to ignore. Now, the interesting dynamic this sets up is um, a couple things. One is that if breadth starts to get too extreme, you almost get oversold in the areas that are underperforming, right? So a lot of times you have to almost view it from that lens as well, is that when you get narrow breadth, it could be a negative, but then if it gets too narrow, then the areas that are kind of unloved can easily squeeze on you. Right, so I think that's a potential dynamic to be watching here into end of year, but really just want to highlight, this market's been driven really by kind of the S&P 10, let's call it, especially over the last few weeks. And I think a lot of that was driven on this idea that, well, we're going to get a performance chase. What do you buy? You buy the stuff that did really well all year. That's been the S&P 10, and you kind of saw that, I think, driving things. Now, I'm not convinced that that's still not going to happen, right? Like I just want to make that point clear that we can still get a performance chase. This just might be a shaking of the tree before. It just didn't happen as soon as November 1 when people are looking for it. Then it might be more of a December story, whatever it is. And this could just be kind of the necessary pullback you needed before you get that type of move. The flip side would be that people start taking their chips off the table. And we just don't get it. But I think it's an interesting dynamic to be watching here, because I think it is a bigger important, that behavioral aspect of markets, that game theory aspect of markets is very much in play over, kind of, call it, the next 2 months or a little less than 2 months before end of year.
Yeah, at the index level, we're flirting with that 50-day. We haven't been there in a number of months, so that'll be an interesting test to watch. Typically, we don't call a breakdown in one session, right? So not only will we be watching this afternoon, Friday, we'll watch it certainly early next week as well. And that, if it holds, could be a logical place for some buyers to come back in, at least at the index level. But certainly, I think in terms of the areas that aren't working, healthcare might have been first, right? Healthcare wasn't working for a very long time. Then it started working. And so maybe some other sectors follow that playbook, and you start to get some other better performance from, I don't know, areas like industrials, materials, utilities, real estate, some of these other areas of the market. Well, utilities have held up well, given their defensive nature, but there's certainly a lot of names that are not working in the more economically sensitive sectors. So we want to watch the Mag 7, this S&P 10, but we certainly want to pay attention to the rest of the market too. So speaking of the Mag 7, here you go. It's
Yeah.
testing a support line just like the S&P 500 is. And by the
Yeah.
way, the tech sector is also testing its 50-day.
Yeah. Yeah, and you can't really see it in here, but there's a purple line in there which coincides with that bottom white channel line, which is the 50-day, right? So pretty nice confluence there of two big levels. But yeah, I wanted to highlight, again, looking at it from that, well, market looking for a performance chase. What happened, start of the month. We come in and Mag 7, which is driving everything, which theoretically is where the money would want to go in a performance chase type of dynamic. We were at the, you know, basically kissing the top end of that channel that we've been in for basically since the April lows. We had that kind of initial drive up and then have been in a nice channel since May. And we got up there, touched it at the end of last month, and then got real close again to start the month. And it was kind of a natural level where you'd expect some resistance, uh, you know, just to be like simple about it, and we pulled back within that channel. I think we actually undercut it by a little bit today, but that's kind of where we are, right? So where this is completely a normal pullback dynamic so far, kind of going back to the bottom end of the channel, going back to that 50 moving average. I think, where you can maybe make the case that we might not get the performance chase dynamic is if we were to kind of take that channel line out, take it for the moving average out convincingly, right? Not an intraday kind of flirt below it, but actually like a real breakdown below it, maybe even go back up, test it, it turns into resistance. Those are things I'd be looking for to signal that maybe we're getting kind of a deeper pullback, a deeper correction scenario starting. Not there yet, and I think right, kind of we started to kind of bounce here late today, so I think maybe that's what you're seeing is kind of buyers coming back into the market right around these clear support levels. Something I'd be watching, just given how influential Mag 7 has been on the broader market, makes up 40% plus of the S&P 500. So kind of, so goes the Mag 7, so goes the index right now. So I think these are really important levels from a short-term perspective to be watching. And, again, if we hold here, we could very easily see that performance chase dynamic kind of the narrative kind of build back up again, right? So I think these are pretty critical levels from a near-term perspective.
Yeah, it's nice to see this intraday bounce today, not just in tech, but broadly. We'll see if we can get back close to even. But yeah, these support lines, when they all line up, they get my attention more than they normally would, even as a fundamentally focused strategist. So thanks for that, Kristian. Great stuff. Let me do a quick preview of the weekly market commentary, which will be out by the time you see this on LPL.com. Jeffrey Roach's attempt to put the AI investment into perspective. So I pulled one chart from his commentary, which shows the data center component of non-residential building this is in the GDP data. And you see that data centers are just booming. I mean, gosh, if you go back 2 years, we're talking about like a triple. Data center build out booming and everything else sliding. So there's not as much non-residential construction going on, ex data centers. So this just one attempt, one way to put this into perspective. He has a couple other charts that attempt to do the same thing. This is not breaking news here, but the AI investment story is huge. It is absolutely enormous. Now, part of the reason for the sell-off this week is because people are starting to doubt whether these promises will actually be delivered. There is still great promise. I don't think too many people disagree with that from AI, but these are really, really big numbers, and there's increasing scrutiny on whether the dollars will actually be there. So I'll throw that kind of caveat in there as we talk about how big
How are you going to,
these numbers are.
how are you going to fund this, right? How are you going to raise this money? I think,
Bingo.
the story for the most part the last few years has been, well, these big companies have, for the cash flow to be able to do it. And now you're having to go into the debt markets, find other ways to finance this. I think that's maybe what's causing a little bit of this questioning, the ability to continue at the same pace going forward.
100%. And OpenAI is not Alphabet or even Meta, where they have the core business that can support this spending to this level. So that will take some time. So good thought there. Let's keep going, Kristian, and do the week ahead, which is tricky. I didn't put a data counter in there because it would have just confused people, because we're probably not going to get any of the government data. So I just put a list of things here to watch. The earnings really dies down, right? We're only going to get, I think it's a dozen names or so in the S&P 500 next week. It's kind of a pause that refreshes, because then we really get a pickup in some of the later reporting retail and tech names. But there will be some reports for people to digest. I think, though, it makes sense to take a step back and just look at the earnings power here that we've gotten. The S&P 500 is going to expand margins from Q2 to Q3, even as tariffs ramp. Not too many people saw that coming. And remember, we and most others thought that we'd get an upside surprise to earnings that was maybe a little smaller than what we've seen in recent quarters because of the tariffs. Wrong. We got basically the average upside surprise that we see in the last few quarters. 7%. Unbelievable. So earnings are going to grow 15, maybe even 16, 17 if you take out Meta's tax charge. That is impressive. Of course, the market isn't responding positively to that right now, but again, it still creates a positive, a strong fundamental foundation underneath this market as long as those earnings come through. All right, with that, I will hand it over to you, Kristian, to talk about what else you're watching.
Well, just on your comment, I would add in maybe, I still not sure the tariff impact we really understand it fully because I think you're starting to see margins come under a bit of pressure now though too,
Fair,
right?
yeah.
I think that's probably a big catalyst why we've seen more layoffs, starting to see an increase in layoffs. But I do wonder if, so you can make the case essentially that they've, companies basically took the brunt of the tariff impact, but as margin pressures become greater, does that still happen, right? I think it's still a dynamic that we don't fully know, but just something that I'm watching out there. And in terms of, broader calendar, yeah, I was looking at the global calendar coming into this call, and there's not much going on there either. It's probably one of the weeks where, assuming we don't get U.S. data and international data is really light, it's probably one of the weakest calendar weeks I've ever seen in my career in terms of there not being any things to be watching out for. I would add in there, the betting markets are starting to kind of price in an end to the government shutdown. Starting really next week is when you're starting to see the potential for it. So I'd be watching for that as well. Maybe that headline, as I mentioned earlier, you know, that could, in theory, kind of be seen as an induction of liquidity into the system that could help things. Maybe be a positive headline for risk or something else I'd be keeping a weather eye on for.
Yeah, and then we got the CPI, it was delayed last month. So maybe we will get the CPI in the next week to 10 days. We'll have to see. But as I said before, I don't think inflation data is as important right now, given the environment. I think people are more focused on the job market and growth. And I would bet that we're going to get the jobs data before the Fed meets. And if you get that data and it solidifies the market's expectation that we're going to get a cut in December, the end of the shutdown and the pricing of that cut could potentially help stocks from that point forward. So a lot of uncertainty, but there's certainly, as you alluded to, Kristian, some positive catalysts here potentially that could help us follow that positive seasonal pattern because you end the year positive when you have a strong year through October. It's almost every time.
Yep.
And so while that enthusiasm for the late year chase maybe got over its skis, it's still there's still a good chance that it comes. So
Oh, yeah, it's a path to get there, like I said, right? I think there was too much thinking that the path would be linear, right? And there's a little bit more zig and zag before that happens. But yeah, I'm kind of in your camp where I think it probably does end up happening. It's not wasn't going to be as linear as the markets were probably thinking on November 1.
yeah, I know that's a favorite topic for Adam Turnquist, our technician, talks a lot about how bull markets aren't linear. And this one certainly is not, although
It's
it
felt
was
like it the
between
last six
it was
months.
between May and October. What's that?
Saying it's felt like it the last 6 months.
Bingo. We were saying the same thing.
Yeah.
All right, so we'll keep watching for data, a break in the shutdown, earnings, evidence that AI is going to reach its promise, and then this ongoing test of 50-day moving average for the S&P. So we'll go ahead and wrap up there. Again, by the time you listen to this, you will have already had hopefully a good weekend. So everybody have a wonderful week. Thanks, Kristian, for sharing all those great insights. It's a tricky time. There's a lot of, let's call them cross currents in this market to sort through. So thanks for helping our advisors and clients and everybody else listening understand all that. So everybody have a great week. Take care, and we'll see you next week.
See you later.
Thanks for listening to Market Signals. Bye now.